Welcome to Pro News Weekly. Let's dive into the updates on the financial markets. The dollar started the week touching the 110 level on the DXY, hitting more than two-year highs, but was under pressure for most of the week. The dollar peaked when markets were experiencing their most hawkish expectations for the key rate, with a 32% chance being priced in that the rate would not be cut before the end of the year. Now, the probability of that outcome has been halved, taking 0.7% away from the dollar index. The dollar bulls have nothing to fear for now. Their dominance is clearly visible on the chart in the form of a flat growth trend since the beginning of October last year, which is replaced by relatively short-lived corrections. Technically, we will be able to talk about the breaking of the upward trend only when DXY falls below 108, and now it is at 109. So far, the fundamentals are in favor of the dollar, as the Fed's main competitors are expected to cut their rates 2 to 4 times this year, while America can do with one. Meanwhile, the key rate is much higher, which also feeds interest in dollar-denominated assets versus those denominated in euros, pounds, yen, and Canadian dollars. U.S. indices appear to have reached their inflection point at the start of the week. It now looks as if the markets have completed their corrective pullback on January 13th, returning to growth. This comeback has been fueled by softer inflation numbers that have reduced fears that price increases are once again spiraling out of control. The S&P 500 stalled in early December due to fears of a strong labor market, and then subsequently went down. However, a strong economy is not such bad news for the markets, so there was hardly anything more than a correction on the agenda. And it appears to have come to an end when investors concluded that inflation is not yet accelerating. The price of gold has risen to the $2,715 per troy ounce level, testing local peaks from late November. The price is now about 2.5% below historical highs. The technical picture leads us to conclude that the corrective pullback of the previous 2 months is coming to an end. It was a shallow correction to 76.4% of the rally from October 2023 to October 2024. A breakout to the 2,800 levels with a renewal of historical highs could launch a real gold rush, with a technical target in the area near $3,400 per troy ounce. The cryptocurrency market has returned to capitalization levels near $3.5 trillion, adding about 3% each day after falling to $3.14 trillion on Monday. The crypto market last reached these levels on January 7th, meaning we are seeing a quick recovery from the failure, such is characteristic of strong bull markets. Sentiment in the cryptocurrency market has returned to greed territory near 75. The January 10th index failure to 50 attracted sell-off hunters. Bitcoin is testing the $100,000 mark again. During the week, there was a brief dip below 90,000, which seemed like the surrender of weak hands, which only attracted new buyers. There has been a real treat for XRP holders. The coin exceeded 3.30 on Thursday, rewriting the historical maximum set way back in 2018. As we recall, XRP rose 5 times in November, drifted with a slight downward slope in December, and rallied in January. Localized victories in the SEC's long-running legal battle against Ripple provided the positivity. On Monday, January 20th, U.S. markets are closed for Martin Luther King Day celebrations, which will affect the trading hours of exchange-traded instruments such as U.S. stocks, indices, and futures. Trump's inauguration is scheduled for the same day, which may affect trading dynamics in the currency market and global stock markets. On Tuesday, the dynamics of the Canadian dollar can be affected by the report on consumer inflation. Since August, this indicator has fallen to the 2% target for the Bank of Canada, allowing it to reduce the rate to support the economy. But the big question now is whether the 7% inflation rate spurred the loonie's collapse over the last quarter. A CPI acceleration could support the Canadian dollar on a reassessment of the outlook. The Bank of Japan may raise its key rate Friday morning, marking the third increase in nearly a year. This very Japanese-style leisurely phase of policy normalization is likely to continue, guided by the rising sun's long-term government bond yields flying to all-time highs. The tightening of the policy could provide fundamental support to the Japanese yen. Also, on Friday, the preliminary estimates of PMI indices for European countries will be released. These are often very influential indicators, which can visibly affect the dynamics of the euro. This is especially true for Germany. Stay tuned to Pro News Weekly for more updates on global markets. Like, share, and subscribe.